everybody. Welcome to the, I guess it's the second Metal Investors Forum, pre-PDAC. I've been doing these pre-PDAC shows for a while. It used to be the Subscriber Summits. It's now the Metal Investor Forum after we merged the two things. I'm just going to do a quick run through on the sort of more big picture level on what I think markets and metals are going to do. It's been a bit of a confusing year because we've had a couple of pretty rapid turns in market sentiment and in metal market sentiment. Generally speaking, this isn't always true. I don't like making generalizations like this, but generally speaking, I'm going to make one anyway. Precious metals tend to be counter-cyclical. That is, they tend to do well in periods of weak growth or low interest rates, although I want to point out right away I'm oversimplifying here, because really when they do well is when you've got negative real interest rates, and you don't need to have a slow economy or a recession or anything for that. Basically the central banks simply need to be behind the curve. You can actually have a strong economy and still have very strong precious metal prices, as long as you've got that situation where you've got negative real rates. If you go back to the, say, 2004, 2008 period, world economy was doing quite well, and so was gold, and in large part that was because of the negative real rates. And gold, of course, did even better in 2011 and 12 because the rates got even more negative. And in the last couple of months, we've seen a couple of big switches. We've seen the Fed, you know, basically the opinion of Wall Street is the Fed came to the rescue of Wall Street. There's probably some truth to that. I don't think I would overstate. I think it's a bit of a dangerous conceit to make the assumption that everyone on Wall Street does, which is essentially that the Fed does their bidding all the time, and the Fed suddenly got more dovish because they're special snowflakes and Powell loves them. It doesn't seem to have occurred to a lot of them that he may have had other reasons for wanting to get more dovish. I think, in fact, he did, and I'm going to go through a couple of those in a couple of slides here. But essentially going into the very start of this year, we saw a pretty nice run in the gold price. Of course, New York scared everybody and came within a hair's breadth of hitting a bear market right at the end of last year. We've seen a very large rally since then. It looks to me like the rally's starting to run out of steam a little bit, although it's still a pretty impressive move. And that move we've seen in the last week or so, it's made another switch yet again where you see the gold price weakening a little bit because the markets have gone very risk on again. There's been a couple of indicators in the US that were good enough that I think you've got people a little bit concerned that maybe the Fed's going to be a little less dovish than they'd hoped a month ago, although the Fed hasn't said anything to that effect. But you've also seen, at least until the last couple of days, a fairly steadily improving picture in China, which has been a big concern for a long time. Their growth rate's been slowing for years and years, but there were some signs of bottoming in the last couple of months. So you had this flip again where, you know, gold basically lost its momentum, but you saw the base metals really pick up in the last little while. And I think we're going to see a couple of these switches back and forth as we go through this year. So it's going to be, I think it's going to be a fairly tricky year overall. And you got to be prepared to be moving back and forth between the base metal and the precious metal side. I'm very comfortable about most metals, base metals, especially copper. I think medium-term and long-term fundamentals are fantastic. I think it's going to do extremely well, but keep in mind that base metals in general are pro-cyclical, so if you get very slow growth or you get a recession in North America, it's going to hit base metal prices in the short term. Sentiment alone will drive prices lower. So as comfortable as I am medium and long term, that doesn't mean we aren't going to see a bunch of turbulence in the short term. This is basically what happened in the last little while. You can see the big scare late December. That's a pretty big move back we've had. It looks to me like it's flattening a little bit, but again, you know, it's what we saw, you know, numerous periods in the past where Wall Street has decided the Fed's got their back. The Fed basically went dovish because the S&P dropped. You know, I think that was part of it, but I don't think that was all of it. I think the Fed actually had some other reasons for it that Wall Street so far is not really paying attention to, and I think that we need to sort of keep an eye on some of this stuff. Gold, just to put that right up front, since it's something everybody's so interested in, you can see right on the very right-hand part of the chart, this is a 3-year chart. We had a kind of a crappy week this week. We dropped back below 1,300. I don't necessarily think the move is over, but I mean, obviously we want to see it climb back over 1,300 in the next few sessions to give us some comfort. 1,350, it's a round number. A lot of people focus on it, but if you look at where that green line is, that's sort of where gold topped out like 4 times really in the last 3-4 years. It's about the 1,365 level, and that's the level we really want to watch. Because if we get over that level and hold that, I think you'll see a bunch more generalist money come in. I do not think as yet there is much, if any, generalist money in the gold space. You know, we got a bit more industry side money, common investors in the gold space, increasing positions in the last 2 months, but I don't think we've got much generalist money yet, and I don't think we will until we get on the other side of that green line and it holds it. But that'll be, that'll be happy days for most of us in this room, because the generalist money is obviously several orders of magnitude above the money that usually plays this space. But that's the level people have been watching. That's where it's sort of topped out 3 times in the last 3 years. So really to get the other money, to get the Main Street money into this sector, we need to be on the other side of, let's call it 1,370 to be on the safe side. So that's the level I'm really, really watching for. And, you know, like I said, I mean, the combination of the Fed put, general bullishness on Wall Street, everyone's gotten pretty risk on again. Most of the commentary I see is, you know, clear sailing, full steam ahead. You know, that was just another blip. We got 2 or 3 years of growth ahead of us. It's all good. I want you to take a good, close look at this chart. This is something I touch on in the newsletter fairly often. This is simply the latest version of this chart, which subscribers would have seen a few times over the last 4 or 5 years. There's essentially 2 types of economic indicators and economic readings that you see in the mainstream media, in the financial press. There's what I call soft data, and that's essentially survey data. You know, things like consumer sentiment indexes, business sentiment indexes, spending plans. Those are all survey data. Someone goes out and actually asks people. It's what you call soft data. Hard data would be things like vehicle sales, retail sales, bank lending. That's where those are metrics that are actually based on measuring things. I'm always very careful to try to keep an eye on the hard data rather than the soft data. I tend to be a real skeptic when it comes to things like consumer sentiment indicators, because what people say they're going to do and what people actually do aren't always the same thing. And I think that's particularly relevant right now, because if you look at this chart, you'll see 2 lines there. Basically, the bars on the bottom are the actual growth rates. The projected growth rate you'll see based on this chart. And I put this one up intentionally. It's a month old. They show a projected growth rate based on the hard data of just about 2.6%, which is almost exactly where it came in yesterday when it was announced. But if you look at the 2 lines, the red line is the hard data readings, the green dotted line is the sentiment readings. If you went on the sentiment readings alone, you'd be expecting an 8% growth rate in the US. If you go on the hard data numbers, you're expecting about 2%. So I think it's important to keep in mind that those hard data numbers are the ones that tend to be borne out. So I wouldn't get as caught up as a lot of people are on Wall Street right now with the positive sentiment stuff, because people have gotten very bullish very fast again. To use a good example of this, a couple of weeks ago, the retail sales number came out for December. It was a horrible number. I mean, it was quite bad. They were expecting a 0.4% year-over-year growth rate in retail sales. It came in at minus 1.7. That's about the worst number that's been put up in over 10 years. Everybody assumed the number had to be just bogus, and you do get bad stats sometimes. It happens. These things are statistical. They all basically have margins of error that are fairly large. But one interesting piece of data that came out a couple of days ago, that's the chart on the right. The chart on the right is same-store sales volume, year-over-year volume on credit card sales, which is something that's tracked very closely, because obviously every time you buy something on a credit card, it's being run through a bank's computer system, so they're able to get that data quite fast. Interestingly enough, you'll see if you take a look at that, the year-over-year growth rate in credit sales, which is most of the sales in the US, dropped from 6% down to about 1.8% in the course of 2 months. What that tells me is that retail sales number that Wall Street assumed was bogus probably is not bogus. That's probably the real deal. And I would also point out that that number for January, there's several different numbers that come out whenever these surveys are presented. You'll notice a chart on the left. If you look at the title of the chart, it says control group. And the reason why I'm looking at the control group is that's the retail sales number that goes into the GDP calculation. They use a specific subset of the retail sales for GDP calculation. That one looks just as bad as the rest of them do. So I'm assuming Q1 is probably going to come in sub 2% in terms of growth rate in the U.S. It may be quite a bit sub 2%. I think it's going to be a nasty surprise. And the last thing I just want to show on a more general level is this is a recession indicator that the New York Fed puts out. They've been running this thing for decades now. Right now, that reading is 24%. And what that is that's the probability of a recession starting within 12 months in the U.S. One thing I want to point out is that indicator almost never goes over 30 or 40%, just the way they structure this reading. It's actually, you would think when you hear that it's a percentage that, okay, well, we've got to wait for it to get over 50 or 60% to really worry about it. Truth of the matter is, normally when it gets over 20%, most of the time it keeps going higher. Most of the time when it hits 20% and goes higher, you are in fact going to see a recession within 12 months. It's basically 100% probability. Personally, I think the odds are reasonably good. We see a recession starting in 2019, not 2020. Not right away, probably later in the year. But I think you got to keep in mind that my expectation, at least, is that it's not going to be well into 2020, as Wall Street's assuming. I think it's actually going to be this year when it starts. I'm not expecting anything cataclysmic. I'm not expecting the end of the world or anything. Probably just garden variety recession. But Wall Street in particular is very definitely not priced for this. So it's definitely something we got to watch out for. So, basically right now, this is just a recap of the first set of slides. Hard readings have gotten a lot worse over the last couple of months. Notwithstanding that, everybody's bullish as hell on Wall Street. It basically comes down to the Fed, the Fed, the Fed. It's all about the Fed put. And I do think to some extent the Fed has their back, but like I'm saying, I don't think the Fed made that switch, got as dovish and as accommodated as it did because of Wall Street. They're not doing it because the guys on Wall Street are special snowflakes. They're doing it because they're looking at data and they're concerned about stuff. They're not just doing it to make Wall Street happy. And right now, I think the one concern I've got with the Fed, but it's actually a very positive thing for the gold market, is because they've stalled out already, because it already looks like they're probably not going to do any rate increases this year, unless we see another upside surprise and the growth speeds up again in the U.S. It sounds like the Fed's about done. They're still doing, right now at least, 10 or 15 billion a year in balance sheet reduction, which is basically quantitative tightening. That seems to me like the one tool they've really got. If things really slow down in the U.S., and again, I'm saying, and I'm not expecting a deep recession, but if we get one, they don't really have a lot to work with. Their toolbox is actually pretty empty right now. So that to me means if there's any appreciable slowing in the U.S. and they really get worried, we're probably back to quantitative easing again. That's really the only tool they've got. They don't have enough rate cuts to really make much of a difference. That's good news. If you like commodities, that's good news if you like gold, because that scenario is very definitely very bullish for the gold price. And it's actually pretty bullish for commodities in general, because it's likely to be bad for the US dollar if they flip-flop again and start quantitative easing. And that, I think, will happen if we see even a mild recession. Conversely, China, which has been a worry for years. I mean, I've only thrown up short-term charts here, but if you look at a 10-year chart of the Chinese growth rate, it's basically been declining. It's been upper left to lower right for like 10 years now. I mean, part of that's simply normal as an economy gets bigger and the average wages and average per capita GDP goes up, the growth curve flattens. I mean, you can't grow 10, 12% with people earning $50,000 a year like they did when people were earning $500 a year. It's normal that it's going to flatten. But even so, it was getting pretty concerning, and there was a lot of concern, justifiable concern, I think, about lending and credit quality in China. One of the biggest turnarounds we've seen in the last little while, if you look at the chart on the left here, that's credit growth in China, which had been stalling out for a couple of years. That was partially intentional. Beijing was trying to rein in some of the more speculative lending, especially some of the non-bank funds and the shadow banking part of their financial system, which they don't really have much control over. They tightened up on that. And I think if you take a look at the chart on the right, you'll see the blue line is the PMI, the Chinese PMI, the official PMI rather than the Western. There's a couple of Western companies that generate purchasing managers index that are probably a little more reliable, to be honest, but that's the official government one compared to metal prices. And you can see it's just starting to pop up a little bit at the end, but you're seeing a move in the base metal prices. There's a very clear correlation between base metals and China's purchasing manager indexes or their growth indexes, which is no surprise because China is, of course, the 800-pound gorilla when it comes to base metals. They're far and away the largest user of all of them. That U.S. sentiment, but especially the China sentiment, it's created a pretty nice bounce in the base metals, which were looking a little sketchy, really, not that long ago. If you take a look at this 3-year chart for copper, take a look at the very right-hand side. We've seen a pretty nice 30 or 40 cent bounce. It's back up in the high 290s a pound now. It'd be nice to see it up above 3 again. 3 is where it was sitting through most of 2016, 2017. There is a chance we're going to see that. If you look at the chart on the right, that's a 5-year chart of the London warehouse stocks. Shanghai is at least as important warehouse stocks as London used to be, but the numbers are about the same there. You see a lot of copper going back and forth between the two sets of warehouses, but essentially that's an accurate one. And you can see there's a big drop-off in the LME warehouse stocks of copper over the last 7-8 months. It's dropped off quite substantially. So that gives me some comfort that the copper price is going to be okay. Like I said, if there is a recession in the U.S., you'll see base metals get hit because it'll just be sentiment trading. They'll be selling it. But the more important part of it is if you look at the bigger picture story for China, this is going forward out to 2022. The gray bars that you see pointing down, those are annual projected supply deficits. Essentially the supply coming in less than the demand that year. Obviously this is generated, they've built assumptions into it like a stable growth rate. If we have a recession, that's going to shift everything down and then back up again. So you might still see copper prices drop during a North American growth weakness period. But the big picture story here is that long term, there simply aren't enough new operations coming online. And one thing I would add to this is if you look at the numbers for the copper sector, for the supply side, if you look at most of the big operations, the ones that really matter, the ones that generate 2 or 3% of world supply from one operation that are coming on stream, the bulk of those right now are what's called bulk underground mines. I don't have time to go into block caves and stuff, but suffice it to say, block caves have very long lead times, very high upfront CapEx because you essentially have to put all of the workings in before you start mining because you basically mine them from the bottom up. And excuse my French, they're really easy to fuck up. There's not many companies that are really good at doing block caving. Some of the companies developing very big copper mines don't have a lot of experience block caving. So personally, I won't be shocked if we see that supply deficit number get even worse because of any one of these things, and 2 of them are already late, like they're about 18 months late now. 2 of them have already moved their projected production starts back. That kind of thing will have a big impact. So I think the outlook for copper in particular is very, very good. Stories similar with lead and zinc, although zinc you have seen new mines coming on stream. There's a lot more production in China itself for both lead and zinc, especially zinc. A lot of this is small kind of mom and pop operations. They're a lot harder to keep track of. Part of the reason why we've seen a move in zinc in the last couple of months is that the bottleneck is not so much on the mine supply side, it's actually at the smelter level. There's been a lot of smelter shutdowns in China in the last little while. The Chinese, as I've said for years, as John has said for years, Kaiser and I have both said the same thing, and that's that Westerners are underestimating how serious Beijing is about some of their new environmental regulations. They don't have a choice, they have to be. I mean, the environmental situation over there is horrendous. Anybody that's been in Beijing, I don't have to tell you what the air quality is like. I mean, they don't have a choice. They need to fix that. And they are actually quite serious about doing it. And one of the outcomes of that, there's quite a few smelters in China that are right now basically under suspension. So they're either going to have to spend significant money, improve their improve the air quality, improve the quality of their tails, or they're just not going to get licenses to restart again. That bottleneck is actually what's driving the move in the zinc price. It's not that there isn't anything coming out of the mine site, it's that there isn't enough coming through the smelters. And of course, any of these base metals, most mines produce concentrate. They don't produce metal. It goes to a smelter, and the smelter is the one that produces the metal. So it's hard to say how that's going to pan out. I think there's potential for zinc to drop back later this year if some of these smelters come back online. But we just, it's a bit of an enigma. We don't know what's going to happen with these smelter licenses. Lead's a little bit more clear-cut. It's some of the same smelters, but lead, unlike zinc, there really isn't much of anything in the pipeline. Lead's lead. It's not a metal that anybody's really in love with. It's got a lot of obvious ecological problems, and it happens to be poisonous. I don't know anybody that goes out looking for lead deposits. So right now, there's really nothing in the pipeline. So even though I don't expect huge growth, there is a couple of % a year. I think lead might actually surprise all of us and do a little better than people think. And there are, it is an important component. The other thing with lead is most of the lead, there's literally a handful of lead mines. Most of the lead's produced at silver mines. I don't happen to be a silver bug. Silver, unless silver sees substantially higher prices, you don't see a lot of startups there, which means you're not going to see the lead coming out as a byproduct. So very short-term base metals look a little bit better, but again, like I said, I think there's good odds we're going to see things flip again sometime later this year where base metals get weaker, gold gets stronger. A lot of this is going to come down to how the trade dispute with China gets settled. Right now, I think it's going to be settled, and it's probably not going to be that nasty. They didn't reach a consensus at the meetings they had last week, but the way the U.S. came out of that without, they pushed the next tariff round back, I don't think they want to make things worse, so I'm assuming we're going to get some kind of resolution of that that's not too ugly. If you're looking at base metals, tier 1 miners, they always want scale, they want big. I like big too, but I'm a big fan of margin. At the end of the day, I think it's high margin that's going to get you built if you're following an explorer or developer. High margin, high grade end size is obviously the best combination, but if you got to pick, I tend to favor grade. The other thing that's always going to be in favor is discoveries, especially gold discoveries. Right now, the market's very focused on high-grade gold discoveries. They get a lot of attention very fast. We've seen a lot of stocks have fairly big moves recently because of new discoveries, one of which is the gentleman sitting to my left, who's going to be the next one speaking. And basically, like I said, if the U.S. slows as fast as I think it will, faster than consensus, then we're going to see that flip again, where we're probably going to see gold get stronger, base metals get weaker. So any of these things, you got to be ready to trade them. I mean, these are all, I'm not quite, I don't go quite as far as Doug Casey with the lit match analogy, but he's not wrong in the sense that when you're trading development and exploration stocks, when the market gives you a freebie, you take it. When the market gives you a triple or a quadruple, the first thing you do is get your money back out. That's simply how you have to trade this stuff. Mother Nature is a bitch. The odds are against you. You got to trade things that way. Okay, that's all I've got to say for now.